Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so as most of you know, interest rates have gone up over the last 6 months, and the market crash crowd, that the housing market's going to crash, has been touting the interest rates as the reason the housing market's going to crash, right?
Right.
Well, unfortunately for them, and good news for everybody else, something miraculously has happened 2 weeks in a row. What has happened the last 2 weeks that is not getting a bunch of press?
Right. So the last 2 weeks in a row, mortgage rates have gone down. Yes.
They've gone down?
Down.
Here, can I put up the chart?
Put up the chart.
There's the chart. Mortgage rates post the biggest drop in more than 2 years. Boom. So this is, now remember, this chart is only since beginning of 2020. So it's a little over 2 years. So it looks ugly. Like, oh my gosh, look how high interest rates are, right? Because at the bottom there, it's like 2.5%, okay? And then at the top, it's 5%, but it's actually been dropping. So Juana, why is it dropping even though the Fed has said there's still some interest rate increases coming?
So because the Fed met and they did what they said they were going to do. So a couple months ago, the Fed came out and basically laid out what they're going to do for the next 12 months. They identified how much they were going to raise rates, when they were going to raise rates, and gave everybody certainty. And the market loves certainty. So when the Fed went ahead 2 weeks ago and did what they said they were going to do, then that made it all good. So that's why interest rates went down. Okay.
So just keep in mind that if the Fed raises rates, say 0.5%, that doesn't mean mortgage rates go up 0.5%, because it doesn't work that way. The mortgage rates are tied more to the 10-year note than they are to what the Fed is doing. Not only that, remember that the Fed's first raise of 0.25 and 0.25 caused interest rates to go up over 2%. Because remember, the housing market's trying to figure in the cost of borrowing over the next year through the federal funds rate and how much premium it charges on top of that. So they basically priced in that the Fed would raise interest rates 2% or a little more total. And what they're sort of signaling is that the market looks like all this is working. So all these interest rate increases are working. It's slowing down inflation. Slowing down inflation means that the Fed will maybe potentially, because we already know this, whenever interest rates went up, they never went up for more than 18 months. They always came down after 18 months. They've never stayed up more than 18 months. And one thing that's interesting is every time interest rates went up over 1.5%, what happened to home prices? Every single time. They went up. Okay, I'm going to read you a chart here. I'm going to read this to you. It's not a chart, but it's a thing. At the current 30-year average, a borrower with a $300,000 mortgage would pay $1,628 a month, roughly $346 more than the end of last year. So let's talk about this. The people are saying, but Todd, with rates up, nobody can now afford to buy. Like, you just went from you could buy to you can't buy. Okay, so your $300,000 house is $1,628. It would have been about $1,300 a year ago, maybe, right?
Right.
So how does this really affect housing? Does that mean that like nobody can buy, or what? Because I mean, I'm guessing a lot of people can afford $1,600 a month. They're probably paying more than that in rent.
That's what I was going to say. Is when you look at house values, I don't know about other parts of the country, but in Las Vegas, so a $300,000 house in Las Vegas is going to rent for about $2,000. So using that, then even a $1,600 mortgage payment is much more affordable. Plus, you also get subsidized by the government by being able to have the interest rate write-off. So you've got kind of that going on. As far as buyers are concerned, okay, so if before you were going to buy a $350,000 house, now you're going to buy a $300,000 house, fine, but you're still buying a house. You're just buying a different house than maybe you would have purchased before.
Something else that you have to understand is when interest rates goes up, it doesn't wipe out everybody. It shifts people down the spectrum. So let's say, okay, first of all, you have 20% of the buyers who were home buyers, who are actual home buyers, who are buying with cash, right? Then you have the corporations buying, they're buying with cash. And then you have basically almost the rest, 90% of the rest of the people who are buying with 20% down. So these people are not showing up with a nickel at closing saying, I'm trying to buy the biggest house I can and as max payment I can. I have no other money, because those loans really don't exist anymore. Right. So people can still afford to buy even if interest rates go up. Now, they may not be buying that $500,000 house with a swimming pool. They may have to like forego the swimming pool and buy a $450,000 house, or maybe they buy a little smaller house, but they're still going to buy, like if they want to buy a house, they're still going to buy a house. They're not going to let a $346 a month more payment. You know, if they're buying a house, they're doing it to solve a problem. The problem is probably they want to start building equity. They don't want to, you know, pay rent anymore, or they've always bought houses and they're just moving to a different area, or, you know, family's getting bigger or whatever. So that's something to think about. It just doesn't just completely take out everybody, because we've shown this before. Every time interest rates have gone up, the housing markets didn't collapse. The housing market didn't collapse. The home prices still went up.
Look, no one thing is going to make housing collapse, okay? It takes a combination of things, because we have a very complex economy. It's a complex system altogether as far as home ownership. So it takes a lot more than that.
So we got this really good chart here. This is the historical 30-year mortgage rate chart. This goes from 1971 to 2022. So it's 50 years of data. As you can see, everybody is upset at that little thing on the right where rates have gone up. They went up 2%, right? They really have gone up, but we're still way below. So what happened back there in the 80s when rates were over 18%? Housing market didn't collapse, did it? No. Right? No, I don't just, why didn't it collapse? Like, why is this going to make it collapse? What about all those other times it went up? Because you can look at this and you see all those other times it went up. We've already showed these that home prices appreciate all those times. We're still below. Like, it's still cheap to buy a house. It's relatively, historically, very inexpensive. And we just showed that it's already going down again. Like, interest rates are going down. So this whole craziness of, oh, it's homes are unaffordable is hyperbole, it's hype, it's emotional, but it doesn't actually fit in. It's like, it's still not. Like, we still are actively selling homes in Vegas, and we're putting houses on the market, and they're flying off the market. And these people are not having a problem.
Right.
They're like literally not having a problem.
So, you know, the thing that I've seen, and it's going to sound really bad, but the thing that I've seen is I've seen a lot of different people around homeowners and investors who are advising them to sell homes, and I think that's something to really kind of look at a little bit more carefully. And what I like to say is follow the money. So we're seeing wealth managers who are advising people to sell homes because the market's going to crash. Well, look at it this way. If you're a wealth manager and you were managing $1 million portfolio, and now that portfolio with the stock market repricing is worth $800,000, and you get paid, let's say, 2% of the portfolio, your income just went down because that portfolio that you're managing is only worth $800,000. So how do you make up for that? Well, you get more cash into the portfolio. How do you get more cash in the portfolio? Well, you go to your client. You say, hey, Mr. Client, the sky is falling. Go ahead and sell that investment property, and let's go ahead and put it in the market because the market's low and it's a good time to buy in the market, and the real estate market's going to crash, so it's a good time to do that. So now you're getting that inflow into your into that portfolio. So now you're the money manager and you're managing more money and you get paid a little bit more. So I apologize to money managers out there if that's not you, and I'm not implying that everybody's that way, but you know, we do know that everybody's got bills to pay and kids in college, whatever, and people are trying to make money. And that's one way that money managers make money. The other thing is real estate agents. And I apologize to my real estate agents colleagues out there that this is probably not you, but there are some who are doing this. Inventory levels are low. They're looking for listings. A good way to get listings is to tell your clients and past clients that, hey, you know, the crash is coming. Sell your property now. This is the last train, out of Dodge, so to speak, and go ahead and sell your property now. Again, this may not be you, and I apologize if I'm offending anybody, but you know, we do know that people are looking for business, and that's really the bottom line. So there's part of that too, that you've got people with vested interests who are sitting there saying, hey, the sky is falling, sell your property. So you do need to understand what's kind of driving some of these people to say these things. And some of them may be completely honest, and they may honestly believe that. And some don't know, and they're just following the bandwagon, whatever their reasons are. But selling your property is something that has to really fit your needs. It has to really fit your financial picture, and you need to sell it for the right reasons.
This is anecdotal, but we have as you know, we have probably over 1,000 friends on Facebook that are real estate agents. We acquired a lot of those, went back from a while back. We were the #1 team in the nation. We did 750 listing sites sold in 1 year just between us. And so we were going to conferences, and real estate agents all want to be our friend because they want to find out how they could get that many listings. So we have all these friends that are real estate agents, and it's amazing how many of them post these links to YouTube videos that say the market's going to crash. And then they say, call me to sell your house. Mm-hmm. Like they're feeding this thing of the market's going to crash, call me to sell your house. And I'm not saying they're doing it intentionally, but if maybe they believe it, maybe they think the market's going to crash. I wonder if they sold their house and moved into a rental. Like if they think the market's going to crash, are they selling their house? And so if your financial planner says you should sell your house and put it in your 401k or your retirement fund so I can manage it and make 1 or 2% of that higher amount, ask them, did you sell your house or are you still in it? Like, why didn't you sell your house? Mm-hmm. Like, if you want me to sell my house, but you're not selling your house and you're my financial advisor, so you're not going to take your own financial advice. And ask the real estate agent, same thing. Like, you're telling me to sell my house because the market crashes. So did you sell your house? Mm-hmm. Like, you own a house. Yeah. Did you sell it? Well, no, I'm not going to sell it. Why? Well, I don't know, because I don't want to be a renter. I mean, what if the market doesn't fall? Like, what if it keeps going up? We're going to put numbers together for a video because we actually have a specific situation of like how to gauge if you should sell based on the price. And actually what we found out is that prices have to fall really far before it makes sense because of the cost of selling and some other stuff. That's a whole other video, okay? But the bottom line of this video is that the mortgage rates are still historically low. They're going back down again. Now, it doesn't mean they're not going to turn and go back up again. But it is interesting that the doom and gloom of the interest rates things that is going to crash the market is not shown it's shown zero effect in the market because they've been going up for 3 months, but the decline has slowed, but it slowed because it's almost June now. Mm-hmm. And it does this every single year. We actually have another market update we're going to do where we show the annual. It looks like this. It's a sine wave every year. It goes up and down and up and down. Mm-hmm. Total number of sales. And we're in the part where it's sliding down now. Mm-hmm. So they're going, look, they're pointing at the down where it's going down, going, look, this is the market collapse. It does it every year. And then in November, it picks up again. Total number of homes sold.
Right. So, the market is cyclical as far as throughout the year, right? So it peaks probably around April, and it starts going down, and it kind of sharpens that, and then it starts to bounce back up right at the end of the year, beginning of January. It's just the way the market is every year, and it's a natural market. There's nothing wrong with it. And if you sold your house, great. I hope you sold it for the right reasons. But it just has to make sense. You can't just listen to everybody who is just kind of fear-mongering because that's not healthy, and that isn't necessarily the best way to make choices.
All right. If you like this video, please subscribe, hit the notification bell, tell all your friends, and leave us your comment. We will see you on the next video. Bye.
Bye.